Alrighty, guys. You guys are about to learn about the Invest on Demand method. Hopefully, you guys watched the webinar. Um, if you did not, I believe most of you did. If you did not, please go back and watch it because the basic information is on there, and we're going to build from that from today on. So today is going to be, depending on our time, we have about 45 minutes to an hour together. I'm going to get through as much of the introduction as I can. And then the next session, you're going to learn more about more specifics that you're going to learn today. So I'm going to go ahead and get it started. So basically with investing, mindset is key. And I know you guys hear that a lot with different type of programs or side hustles, but with investing in the stock market, mindset is really 99% of what you do. Because at the end of the day, no matter how much research you do, no matter how much tools I empower you with, no matter how confident you become in your investing, you still have to be able to pull the trigger. You still have to be able to make that first trade. Maiwa already bit the bug. She went ahead and she wanted to go and buy 2 companies, so which was great. And I told her it was great that she went ahead and pulled the trigger on those. But that's really the main thing. You have to keep yourself in the mindset of neutral. And you kind of have to invest like it's a video game. Because if you don't invest like it's a video game, it can become very paralyzing when you start investing with your real money. But don't worry, I'm going to give you all the tools so you can be 100% confident in your decisions when you're investing, to the point where you're willing to buy and put all your chips on the table. So Warren Buffett said a phrase that when it's raining outside, you don't want to go outside with a pail or a thimble. You want to go outside with a wash tub. The same thing is when you find great companies that you can buy and you can invest in, you have to be so confident in your investment decisions that you go all in. Because when you start to diversify your investments, most times you decrease your rate of return. Let me say that again. When you start to diversify your investment capital, you begin to decrease your rate of return. The reason being because the more places you have your money spread out, the more your risk is spread out as well. So everybody always talks about diversification and how it's great. I'm going to tell you how that is actually completely horrible, okay? If you know what you're doing. If you're an investor, if you're taking this course, you're no longer the general public. You are now an investor. So you have to think like an investor. And investors don't diversify the way you think, okay? You have to be willing to load up the truck when you find great companies to invest in, when they pass all the tests and all the checklists that we're going to get into today, okay, guys? So mindset is key, okay? So is it 50% full or 50% empty? It's up to you. It's all how you see and you perceive situations, okay, guys? Number 2, so what you're going to learn today, why mindset is 90% of success, how to be confident in any situation, and how to deal with everyday fears and traps. Okay, I remember my first investment after I did all the back testing, after I did all the practice, after I passed all the checklists, I was shaking. I literally was shaking because it was like a mental thing I had to get over to buy my first investment, because I was like, oh my goodness, this is my money. If I lose it, I don't know what I'm about to do. And there are things you can do to feel absolutely confident. And I had to go through my checklist again to make sure I was confident in my investing decisions, okay? All this is theory until you put it into practice. And that's what we're gonna go over in this course. All right, guys, so I'm gonna also tell you and show you, prove to you guys why the C-value method works and the different theories of investing, okay? And what you're also gonna learn is strategies to get rid of the crippling mindsets that you may have and how to develop a strong investment attitude. Okay, guys? So I'm gonna tell you a story of Mr. Market. If you read the book by Benjamin Graham, The Intelligent Investor, he tells a story of this person named Mr. Market. Okay, and that's the stock market. And the thing about Mr. Market is that he's very emotional. Some days he's overly happy, and some days he's overly sad. So when he's overly happy, he gives you great discounts on companies. When he's overly sad or overly pessimistic, he charges you crazy amounts for the same company. I actually have that backwards. I'm going to repeat that again. When Mr. Market is super happy, when he's excited, he overcharges you for companies. But when he's sad or he's scared, he gives you companies at great discounts. Okay, guys? So when he's super excited, he overcharges you. When he's super sad or super fearful or super doubtful, he charges you under what the company is actually worth. So Mr. Market switches like this day in and day out. And every day, it gives you different prices on the same company, regardless of the performance. So one day, you can be $50 up. The other day, you can be $300 up. And Seth Klarman, he's a billion-dollar investor. He actually manages $17 billion in assets under management. He said the stock market is a story of cycles and of human behavior that is responsible for overreactions in both directions. So guys, our job as investors is to find times when Mr. Market is overly sad or overly fearful about companies that we like and buy it from him. And then when Mr. Market gets overly happy, that's when we sell the companies, okay guys? So you buy from Mr. Market when he's overly fearful or overly pessimistic, and we sell to Mr. Market when he's overly greedy. And this is the whole concept that Warren Buffett said of buy low, sell high. All right, it's a very simple concept, buy low, sell high. It's all based on the reaction of the stock market and of Mr. Market himself. Okay, there's actually a stock called the Fear Index, VIX, that you can actually trade and buy based on the fear and greed of Mr. Market. The Fear Index is called VIX. The Greed Index, I forget what it's called. I think it's VLX. I'll let you guys know what it is later. But the market is actually selling stocks on himself. So it's crazy. It can almost be like gambling in the stock market unless you have a specific strategy, unless you know what you're doing, guys. So remember that when Mr. Market is fearful, that's when we want to buy. And when he's greedy, that's when we want to sell. And Mr. Market is just an overall representation of the collective emotions of everybody in the stock market. Okay, guys? Hope that makes sense. Okay. And to really understand and to really get a hold of the C-value method, we need to understand theories, okay? The mindset of the theories that guides Mr. Market and why Mr. Market behaves so irrationally. Okay, so a theory is a set of beliefs that might explain a certain phenomenon. These theories form hypotheses that can be tested, and these theories dictate behavior. So a simple way to say this is, a theory is a set of beliefs that dictate how you behave. Hey, if you think it's going to rain outside and that's your theory, you're going to buy an umbrella, okay? If you think it's going to be super hot outside and that's your theory, you're going to buy cold water, okay? So a theory is a set of beliefs that explain a phenomenon and dictate your action, okay? And there are three major theories that I want to hit on the market. The first one is the modern portfolio theory, okay? The second one is the efficient market theory. And the third one is what I call the value investing theory, okay? And the value investing theory is where the C-value method is born out of, okay? 95% of the market today, Mr. Market, subscribes to the modern portfolio theory and the efficient market theory. So the modern portfolio theory, and this is its view on portfolio risk and expected return. So the modern portfolio theory makes the assumption that investors are risk adverse, meaning they prefer a less risky portfolio to a riskier one for a given level of return. This implies that an investor will take on more risk only if he or she is expecting more reward. And this guy named Harry Markowitz created this theory and documented it in 1927. And guess what, guys? He actually won a Nobel Peace Prize for this theory. Right? That's crazy, guys. He actually won the Nobel Peace Prize for documenting this theory. And basically, the long and short of this theory is risk is directly correlated to returns. So if you want better returns than the market, it says that you have to take on more risk. That's basically the theory in a nutshell. If you want better returns, you have to take on more risk. If you want less returns, you have to take on less risk. So the more risk you take on, the more returns are available for you. That's what this theory holds. And he won a Nobel Peace Prize for this in 1927. He convinced everybody that this was the right theory. And a lot of the markets started reacting to these theories and started investing as if this theory is true. And it became a self-fulfilling prophecy. Okay, guys? Because people invest based on this theory, it actually has become a self-fulfilling prophecy to a degree, meaning that the market assumes that the level of risk is equal to the level of return and so forth, and therefore invests based on this theory. Okay? So do you guys have any questions about this theory before we move on? It's very important that you guys understand this theory and where everybody else is coming from when they invest based on this theory. All right, guys, I guess no question on that theory. The second theory is the efficient market theory. Okay, and it's based out of the efficient market hypothesis. This guy who wrote in the financial economic department, he talked about assets or stock prices, and he said that they fully reflect all available information. A direct implication is that it is impossible to beat the market consistently on a risk-adjusted basis, since the market prices should only react to new information. The father of the efficient market theory is Eugene Fama. He also won the Nobel Peace Prize in 2013 for his theory. So his basic premise is price reflects value. That everything you can consider about a company, everything you should look at, or even look at whether it's the valuation, whether it's the cash flow, whether it's how good the company is doing, whether it's the technical analysis or the values or the cycles, that it's all already factored into the price. So therefore, you cannot beat the market. Now, this is one of the most erroneous and false doctrines or I'll call theories out there, okay? Because if this was true, then why does the market have crazy swings year to year from different companies? So if you watched the webinar, I showed you guys how people who follow on this theory and people who play the game of funds, that when they leave companies can become hugely overvalued in the extreme because of the fact of misinformation or something that scares off fund managers or other investors. So the efficient market theory just basically says that what the price is actually equals the value of the company. So if Netflix is $5 a share today, that means that Netflix stock is worth $5 a share. If it's $50 a share tomorrow, that means that the Netflix stock is $50 a share. So this is a major theory out there that a lot of investors go by. And based on this, it's impossible to beat the market. But the only issue with these two theories that 95% of the market agree on is that the value investing theory is out there, okay? And more importantly, the people who invest based on this method have consistently beat the market over and over again, okay, guys? So the value investing theory, and I'll quote Buffett, he's one of the godfathers here. The original godfather was Benjamin Graham, and he said that basically it's considering the intrinsic value of a company and buying it at a discount, okay? Graham is considered the godfather of value investing and introduced the idea of an intrinsic value, which means the underlying fair value of a stock based on its future earnings power. So that means cash flow. So I want you guys to think about this company or any company that you invest in as your own personal business. The reason you start a business is for cash flow, to have extra cash that you can use to either invest, save, go to Las Vegas, spend money or whatever you want to spend it on. And when you look at companies in the stock market, you have to look at it in the same way. So Benjamin Graham and Warren Buffett say that you can value a company and actually determine the intrinsic value of that company based on its future earnings power or based on its future cash flow. At any given time, a great company can be discounted way too far because of the fear of Mr. Market. Okay, guys? And with this method of investing, you can beat the market over and over again by buying undervalued companies. Okay, and I'm going to prove that to you guys. So which theory is right? Okay, so 95% of hedge fund managers and people who manage people's money actually never beat the S&P 500. So the market, the most common metric of the market is the S&P 500, which contains the top 500 stocks in the US. Okay, guys? So 95% on average over the last 15 years, and you can look at the data below, there's a chart there. 95% of finance professionals do not beat the market. Okay, guys? These are people who follow the efficient market method and also guys who follow the modern portfolio theory. Those guys don't beat the market. Why? Because a lot of them assume and make assumptions that the market is always right. Okay? And based on their assumptions, they leave their money in the market saying if I take it out or put it in, it doesn't matter because the market is always right. The market is always going to give you a fair value of a company from day to day. Okay? So if you want to be part of the 95%, you want to follow those other theories, feel free to do that. But with the value investing theory, you can beat the market over and over again, okay? So over the last 30 years, these are the club members of the value investing club, people who do not ascertain or believe in either the modern portfolio theory or the efficient market theory. Warren Buffett, over the last 50 years, he has made 19% year over year compound annual gross return. Okay, so that's over 50 years, guys. Seth Klarman, 20% over the last 34 years. So these people have been beating the market consistently over a long period of time. Benjamin Graham, he's the godfather of value investing. He beat it 20% year over year for 20 years. Peter Lynch, he's still alive today. He's beating it 29% year over year for the last 13 years. Joel Greenwald, he's beating it 48% year over year for the last 10 years. So Joel Greenwald, I don't even know how to say his name, right? Basically, he's been doubling his money every 2 years, right? And if you guys saw and if you guys haven't checked it out yet, go into the membership area later and watch the video I created on Millionaire Math, okay, guys? It'll show you guys the path to become a millionaire, even if you start with $1,000, okay? And it's all about doubling your money. So the S&P 500, you have a question? I'm sorry. Oh, okay. So the S&P 500 over the last 30 years has returned a measly 9.8%. Okay, on average, 9.8%. So that means that it'll take you 7.3 years to double your money. If you only reach a 20% rate of return, just a 20% rate of return, you double your money every 4 years, and it'll take you less than half the time to double your money than if you leave your money in the market. Okay, guys? My goal for you guys is to get to a place where you're doing 25%, 30% rate of returns, and even 50% rate of returns year over year.
Mm-hmm.
All right, and to be able to invest in your first company before this course is over, guys. So, guys, do you have any questions about the models, the theories, and the rate of return so far?
No.
All righty. So I'm going to go to the next slide here. And basically, the value investing method basically does this. Okay, guys? That's my dream Lamborghini to the left, and that's a dream mansion to the right. If I came to you and I said, buy this Lamborghini from me for $250,000, would you buy it? Would you buy this Lamborghini for half the price, knowing that in a year from now you can sell it for full price? And that's a question exactly. So that's a question you have to answer. I would definitely do it. I don't know where I'm going to find the money from, but I'm going to find it somewhere to make sure I buy that Lamborghini at a great deal. Okay. Even so, the same a mansion. So when you're investing in the stock market, you're not buying stocks, you're buying companies. And this is going to be the major mindset shift that you have to make as an investor. You need to look at a company as a whole and not as a stock. So when I buy a share of Apple or Facebook or Ozark Bank, I'm saying I'm actually buying the whole company. And that's how you have to look at it. So if you're not willing to buy the whole company for 10 minutes, for 10 years, don't even bother buying it for 10 minutes. Okay, guys? So here's Benjamin Graham. Here's a quote on the book he wrote called The Intelligent Investor. And he said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The intelligent investor is a realist who sells the optimist and buys from the pessimist. Investment operation is one which, upon through analysis, promises safety of principle and an adequate return. Operations not meeting these requirements are speculative. Look, guys, I know you guys have heard me say that if you don't understand a company, then you're gambling. You're being speculative. And if you do that, then you're just paying your broker fees and you're not really investing. So go through this video if you want to read the whole quote in this book. Is actually very interesting. There are good statements in here. But it gives you an overall framework of the mindset you need to have when approaching investing in the market and buying companies. Okay, the stock market is a place where companies go on sale every day. And it is your job as an investor to find companies that fit your model, that you understand, that you know the story, and you can buy at a great discount where Mr. Market is afraid. All right, guys. So, guys, how to be confident. Okay, how to be confident in your investment decisions. All right, if you actually log into the dashboard in the email number 2, there's a video there called the account creation walkthrough. So I know you guys haven't created it yet, but as soon as you get off tonight, make sure you go through, watch the video, okay, create the account, and create the paper trading account for your investing purposes. Okay, guys, this is going to be super crucial moving forward because this is where you're going to practice your trade and then also gain confidence. So, guys, paper trading is a place where this stock or this platform gives you $200,000, think it's one, of paper money, right? And then you can invest it like it's in the real market. Puts it in the real market. You're going to see whether you actually made money or you lost money. And I used this to practice for 3 months before I made my first investment. I was really confident in my investment decisions, and I saw that I was very good at what I was doing. Okay, guys? So creating a paper trading method and back testing is super important. So what I'm going to do now is open my trading account for you guys to show you guys how to do back testing on companies so you can be sure and confident in your investing decisions. Now waiting for the platform to load here at Thinkorswim. Has any of you guys created this account or not?
Not yet.
Okay. So Thinkorswim, the video is in the platform. Like I said, it shows you how to set up your chart. It should take you about 5 to 10 minutes to do it. But when you do it, it's going to pop up something like this, and I'll give it a few minutes before I log in. It's taking its sweet time here. All right, can you guys see this? You guys see this login screen?
Yeah.
All right, great. So I'm going to just log in here. You guys don't spill my password. All right, guys, so this is how I become confident in my investing decisions, okay? I set up all the technical analysis and all the cycles inside the stock account beforehand. And then when I find a company that I want to invest in, I take a look at it first. I look at the charts to see what, if I invested in this company historically, what it would look like. Okay, so this is what it looks like. All right, so I will go here. So this is a company I recently invested in called Ozark Bank. And I'll look at it, I'll look at the company and the stock price over the last 6 months, over the last year, okay? And then more importantly, I like to look at it over the lifetime of the company itself, okay? And this gives me an idea of the performance of the company through history. So between 1997 and 2019, obviously there's been many stock market depressions, stock market crashes. There's a stock market crash here in 2008. And I like to see how the company rebounds through those crises, okay? So when I look at a company like this, one of the first things I look at is historically, does the chart show that when it goes down, it goes back up? So if I bought it here when it was undervalued, would it actually go back up and retain its value? And when I've seen a couple occurrences of that happening, this shows me that this is a good buy this is actually a good company that I can invest in. So here in 2008, it dropped from its high of here $5.47 all the way to $3.35. Okay, so if I'd invested back then within a year, 2009, it would have went back up to the original price of $5.90. And today, this company is actually in the 50s. Recently, it dropped down, and because of third quarter results, people over panicked and sold the company, and it dropped down to actually $26 a share, and now it's back up to 32. So when I was looking at this company, it was right around here before it started going up, and I started looking historically at the chart to see whether historically this company recovered from bad news. So when I see this in a company, this shows me that this company actually has a very good chance to recover even though it's undervalued, okay? So when I talk about, and when I'm talking about back testing a company is really looking through history, the historical value of a company and how it performs through recessions and through good times. So whether the market is being scared or whether it's being excited, okay? So do you guys have any questions about this before I move on to the next point?
Mm-mm.
All right, great. So another thing I do to check the company and check the charts historically is I go to what we call the trade. Let me see the trade. Analyze. Great. Okay. I go to a point in history. Let's say the company is OZK again. In 2008, okay, they didn't have any options there. Okay, but if it did have options back then, I would have went in 2008 to take a look at what the stock price was at that time and what the investment criteria was showing. Okay, you can actually do it from here too. So I like to imagine, let's say the date here is June 2nd, 2008. So I would go here and put June 2nd, 2008. To June 2000 and from June 2008 to July 2008. Do the 11th to the 4th. So this gives me a snapshot of what I will be looking at a company at that time if it decreased during the stock market crash. Okay, guys? And then I could be able to look at this technical analysis to see whether this company is going up or it's going down. Mm-hmm. So watch the video in the account. It goes into more detail on how to set this up and what you're looking for when it comes to back trading companies and testing it out. Okay, guys? But what this allows me to do is have confidence in the company and in my investing decisions because I've back tested the company historically to have an idea how it's performed historically in the past during times when it's actually had a recession or when it's been undervalued. Okay, guys?
Okay.
Yeah.
All right, so here are the rules of the game before you do your first trade or your first investment. Don't buy any company for 10 and a half you're not willing to hold for 10 years. Okay? That's the first rule. Second rule, always buy at a margin of safety. Okay? So when you learn to find out what the intrinsic value of a company is, let's say you think the intrinsic value of the company is $100, don't buy the company unless it's selling for $50. Okay? And when you get good enough at this, when I read a company's reports and when I analyze a company, I can usually predict the value of that company within $10 or $20. Okay, and I've back tested this and made sure I've been accurate. Okay, guys? So when you get good enough at investing, at looking at the numbers, at telling the story, you'll be able to tell whether the company is trading at a 50% margin of safety. And margin of safety is just discount. Okay, so if you think the company is worth $60 and you bought it at $30, the margin of safety there is 50%. Okay, guys? So start with wonderful companies that you're familiar with, that you understand, and have a growth mindset. Number 4, not all discounted companies are good companies. And here's a trap you can fall into. Just because a company is on sale does not mean that it's a good company to buy. So to the right here, I have a chart of PG&E, and I was chatting with Maiwa about this earlier. The fact that it dropped down from almost $70 and today is $8.38 does not mean that this is the greatest company to buy. The reason that they dropped down this low is because they actually filed bankruptcy. Okay, guys? So just because it's on discount doesn't mean you should buy. You need to understand the fundamentals of the business. You need to understand the intrinsic value and make sure that whatever event caused them to drop in price is something that they can recover from. Okay? You want to make sure that it's something that they can recover from, something that's superficial, and not something that changes the underlying business of the company. So for instance, if Chipotle, for instance, got a competitor like Qdoba, which it did, and Chipotle was on Main Street, and Qdoba created a restaurant right next to Chipotle, that is something I will look at as competition to say whether the story of the company is the same or not. Okay? Something like an E. coli outbreak, okay? It's a temporary situation, and companies usually recover from that by putting in new rules and new health and safety standards. But as long as the company does not have any event happen to it that is monumental or they can be career-ending or company-killing, then they're great companies to buy. So you always have to keep a lookout for companies that drop in price to make sure that they're actually wonderful companies and they're not being discounted for crazy reasons, okay? So once you've built confidence, you have to go all in. And this is the part that I cannot emphasize enough. Once you find out companies that you like that are trading at a huge discount, just go all in. Put your chips on the table. You have to be willing to go all in, because if you don't, you begin to diversify your returns. All right? So guys, here's how to get rid of fear. You need to set rules for yourself for your investing criteria. So I talked about the margin of safety being 50%. I'm comfortable enough in my investing now that I buy at margins of safety even 30% to 50%. I don't always do 50%. Sometimes I start at 30%. But for you guys in the beginning, start at margins of safety of 50% till you become comfortable in your ability to pick winning companies, okay? Number 2, check the back test. Check the back test of the company. Look at the chart. Look at the historical value and make sure the company is a good fit, okay? Number 3, is this a 10-year company or a 10-minute company? We don't buy stocks, guys. Remember, we buy companies. So if you're not willing to hold on to that company for 10 years, don't bother investing in it in the first place. Okay, and this will help you guys streamline a lot of your investment decisions. If you're not willing to hold on to it for 10 years, don't buy it for 10 minutes. Okay, number 4, set aside a portion of your investment fund for speculation. Okay, guys, so the options masterclass, when that is released, is going to teach you guys some trades that you can use to make money quick. I'm talking about 10xing, 20xing your money in a short period of time, within 2 to 3 weeks, okay? So if for investments like that, I call those speculative investments. Make sure you set a portion aside of your investment funds for that kind of growth, okay? I usually do 20%. I advise you guys as beginners to do around 5%. I do 20 to 30% just because I'm more comfortable in making those kind of investments. And I only invest in those kind of trades when they follow my specific set of rules, okay? And don't worry, I'm gonna show you guys those rules at times as this course goes on. Hey guys, so before we get into kind of a quick way to analyze companies, do you guys have any questions? All right, do you guys have any questions? All right, great, guys. So I'm going to show you guys a quick way that I use to analyze companies before I buy them, okay? So if you watch the webinar, I'm pretty sure you guys have been looking at companies already that you're interested in or you're thinking might be a good fit. This is how I check the story of a company before I invest, okay? I'm going to get into the nitty-gritty next week on how to start looking at companies and find out their intrinsic value. But before I do a deep dive into any company, I do a quick 5 to 10 minute check, okay? And the first check, I go to the website called seekingalpha.com, okay? Seekingalpha.com, and here's the website. And when you go to the website, you can type in the symbol for any company you're looking at. Let's say, you guys give me a company that you've been thinking about.
Twitter.
Oh, Kim, Twitter. Yeah, that's true. Twitter. How do you spell Twitter? Okay, great. So this is a shortcut to the story. So this company, Seeking Alpha, the word alpha in investing actually is a term used for beating the market. So people are always looking for a way to beat the market. These are actually people in Ivy League schools who are actually finance majors who want to own funds. As part of their dissertation, they have to write articles about companies, and they post it on this website. Okay, so I type in Twitter. There's a whole lot of analysis on the company of Twitter. So before I do a huge research into Twitter, if I think it's at a good price, I look at the analysis, and I just read several of them. So I'll go into this one. You can do a free trial for 30 days, I believe. And then after that, I think it's like $10 a month. So here's a summary. Twitter experiencing a turnaround after years of struggle. Our company is cheap relative to its tremendous cultural importance as competitor Facebook, less sensitive to looming threat of data regulation. So it's giving me all these things. So if I continue my free trial, it will give me the breakdown of the whole company's investment strategy based on what this guy is thinking. And what I do when I read these is that I look for opinions against my belief. So if I think Twitter is a great buy, I'm going to read people's opinions that think that, okay, Twitter is a great buy like this company is. But I also think and read articles that say, no, don't do it. Don't buy Twitter. And what this does is that it gives me a balanced approach on what the company is saying. And when I read negative articles, if I can't answer or have a rebuttal to the concerns that this person has in that article, then I don't invest in the company. Okay? So for instance, here's one negative. It says that a research company issued a $20 price target on the company that isn't likely going to be reached. Okay? If I knew about Twitter, I could answer this by saying, the reason this price target is not going to be reached is because Twitter decided to invest more in research and development this year to develop new technology. And because of that, it's not going to reach its price target this year. But in the next 2 or 3 years, it's going to double or triple in value. Does that make sense, guys? So this is how you have to start to think when you start looking at companies you want to invest in, okay? Here's another objection. The negative call is based on a 2017 report that's already outdated, okay? The 2019 revenue growth rate doesn't accurately reflect the ongoing turnaround of the social media platform. So there are positives here as well, but I just go through at least 3 or 4 articles on this website, and this is a humongous tool for you guys to invest in after the free trial, and read about the company I'm interested in investing in. Okay, guys? This is another thing that I do. The second thing is I go to gurufocus.com. Okay? So I go to gurufocus.com. Here's another website here. And this website is free as well. You probably have to enter your email address to sign up for it. I think they give you a 30-day free trial as well. And what I use this company for is for 2 or 3 things. The first thing is that it does a discounted cash flow of a company for you and gives you what it thinks the value of that price should be. Okay? So using Twitter again. And also, more importantly, it gives you other gurus that follow the seed value method, that follow value investing method, who have invested in this company and let you know what they're doing. So Twitter is TWTR. So I just hit go. And here's a summary of the company. I just X this out. Okay. And I want you guys to pay attention to a couple of things. The first thing is Guru Trades. Okay. So it gives you an idea of the gurus or the value investors. Remember we talked about Joel Greenblatt on the other side. He actually just bought Twitter. So this makes me think, okay, so he bought Twitter. That might actually be a good sign. He bought it at $35.04. Right now it's at $33.27. So I looked through, okay, this is another value investor, just bought it at $29.31. Right now it's at $33. George Soros, he bought more. These people sold some, okay, or sold out. So I looked through a couple of these to see what the overall sentiment of investors are towards this stock. Okay, and if I see several people buying it, you buy, then that's a positive for me. That means that other investors are looking at this stock and it's showing a good positive value, okay? Gurus are buying this stock. Number 3, I look at the discounted cash flow, okay? Remember in the beginning, I still have a free trial, so it keeps popping this thing up for me. So remember in the beginning, I mentioned the fact that the companies itself, you're investing on it based on cash flow. Okay, guys? The market returned 12%. The market returned 9.8% over the last 30 years, but you want higher than that. This website puts a standard 12% discounted cash flow rate on this. You can put as much or as little as you want. So based on this, it pops out for you what the fair value of the company is and what the stock price is. So to me, when I see this looks like I'm not going to buy this company. Why? The fair value of the company based on the cash flow, okay, each share produces $1.35 in cash. So the fair value of that based on a 12% return is $14.45. So if the stock price is not at $14.45, I'm not buying it, okay? The tangible book value, which means that if you sold all the company and you paid the investors back their money, each share of the company is actually worth $6.84, okay? So the stock price is $33. The fair value is $14. If you bought this company right now, you'll be buying it at a margin of safety of 130% in the negative, okay? So based on that, Kim, are you still going to buy Twitter?
Most definitely.
You still gonna buy Twitter?
No. No,
I hope you're joking.
I am.
Okay, good. Hey, don't say G Day taught you that because I'm going to deny it. Okay. So those are one of the two things I look at. And if these things are not positive, I don't even go to the next step. The third step in my quick analysis method is rule1investing.com. Okay, they have a toolbox. So I'm going to go there and show you guys what it looks like. And this is going to be the main tool that we're going to be using throughout the course to really figure out whether a company is worth investing in. Okay, so they have a 30-day free trial. And after the free trial, oh, look at that. I don't know why my thing isn't working. I guess I need to renew my subscription. Uh-oh. I'll create a free trial now. Let's say my name is John Adams. And my email address is, I don't even know why I'm saying this out loud. I'm going to give the email address to myself. Dang, that email already exists. Okay, let me see. Try this email. What happened? Okay, there it is. So once you log in for this is what's going to pop up. You're going to accept the terms and submit. And you're going to have access to the toolbox. Okay, guys? And what I want you to do, I searched the company Twitter. Okay? And this is what it pops up for me. It pops up the meaning, the moat, the management, the predictability of the company, and the Rule 1 score. Okay, these are some of the things we're going to be talking about when looking at a company. Okay, and if these things are mostly red or yellow, then this is a pass for me. Okay, I'm going to be teaching you guys what these terms mean next week. Okay, but when I look at this, another thing I go to right here is called the margin of safety calculator. I go here. Here it has 15%, the return rate. You can put 12% to match the other company, but you want at least a 15% return. The margin of safety, we wanted at 50%, like we talked about. And we hit submit and okay. And it gives you an estimation of what Twitter is worth. So this says the sticker price of Twitter is $108.63. And the margin of safety is $54. So based on this, Twitter is a good buy, supposedly. But that means that these numbers are off because this assumes Twitter is going to grow at a 22% rate. Okay, I'm going to show you guys when and how to adjust this next week, okay? But I look at this as well. So if this looks green, that I should buy the company now, I also take it into consideration. So I use these three tools as a quick guide to let me see whether I should buy the company or not. Another place I go to is the Rule 1 numbers, okay, guys? And I look at the debt. If a company has a lot of debt, I stay away. So greater than 10 years, what this means is that Twitter, for it to pay back all its debts, it's going to need to take all its cash flow for the next 10 years just to cover its debts. So for any reason, if the economy collapses or if the bank can't loan them money or they can't renew their money at a good interest rate, the company can literally go out of business. Okay, guys? So the management of this company is horrible. So some of you might say, it's a tech company. Of course they have a lot of debt. That's not true. Let's look at their biggest competitor, Facebook. Okay, I actually recently invested in Facebook as well, when it was still like $130 a share. So we can look at the Rule 1 numbers for Facebook. Facebook is 3 to 4 times bigger than Twitter, okay? And they have zero debt. So that's a huge swing from company to company. So this is what I call the quick analysis method to really figure out what's going on with the company, whether it's a good buy or not. So I'm always coming across companies every day that I'm interested in investing in. So before I go to find out their story, before I want to know whether I want to find out more, I look at the Rule 1 toolbox, I look at Guru Focus, and then I go to Seeking Alpha to start reading about the company, okay? The fourth thing I do is, we can go back to Twitter here. I look at what the management of the company is doing, or what is called insider trading. So insider trading tracks what the people who are actually in charge of the company, what they're actually doing. And Twitter, everybody is selling their shares. So if the management of a company is selling their shares, I'm definitely not going to buy it. So those are the four things I look at when I first come across a company to decide whether I want to read further. If the company checks all my boxes of this quick analysis method, then I start doing the full research into the 4 M's of the company, okay? And that's going to be the next session. I'm going to be teaching you guys about that next session. The 4 M's are meaning, moat, management, and margin of safety, okay, guys? So that's really how to invest in the company. It's super simple. And if all these things check out, then I look at the technical analysis. I'm going to go back here. Look at the technical analysis and the signals to see whether to buy the company now or not. All right, guys, so that's pretty much it. Do you guys have any questions about the quick analysis method? I know we covered a lot today. I was talking fast. I just want to make sure that you guys understood everything that we talked about.
No.
All right, great. So here's your homework, guys. Find a company by next week, Monday, that passes all 4 tests, okay? That means that you looked at Guru Focus, you looked at whether investors were buying it, you looked at rule1investing.com and the toolbox, okay? You looked at the insider trading, you read some articles about Seeking Alpha, and I want you guys to be able to back up to me why you feel this company passes the quick company analysis, okay? So I want you to write it down, and we're going to go over those companies next week.
Okay.
All right, you guys have any questions? And Kim, don't bring Twitter.
Okay.
No Twitter. Okay, so look at, I know you talked about Chipotle, you're looking at Chipotle and other companies as well. I'm going to put this recording.
Is insider trading a website as well?
No, insider trading, if you go to rule1investing.com, the toolbox here, to the left side, there's a position that says insider trading. So when you click it, it lets you know. So January 16, which is 5 days ago, Evan Williams, sometimes I even say, okay, who is Evan Williams in Twitter? To figure out who he is. If he's a CEO and he's selling, that worries me. What is he doing now? Huh?
Internet entrepreneur.
He's the CEO of Twitter.
Oh, damn.
And he's selling. So you're the CEO of the company. I'm buying the company, and you're selling shares while trying to sell it to me on the market.
Damn.
I'm good.
Dang.
He sold 24,000 of his shares.
Oh, my God.
He's been selling it for the last, just selling out. I'm pretty sure one of the people are the CFO. And the CEO. Yeah, seriously, they're selling their company. So this gives you a snapshot on the company. If you don't believe in your own company, why should I believe in it with you?
Wow.
But couldn't that be like a strategy, kind of? I don't know.
It could be a strategy, and that's why you have to take all things into account. So I look at the Rule 1 numbers, okay? If I'm seeing a whole bunch of red, I'm going to put a video in the website platform to explain each number. So you make sure you guys watch that over the weekend before next week's class, so I don't have to go over it. But if I'm seeing a whole bunch of red here, all these things are red or yellow. I mean, Facebook is green, just to give you an idea.
What are people doing insider trading for Facebook? What are they doing?
So that's a good question. Let's see.
Can't do it by Twitter, man. Somebody in our group gotta do it.
So somebody got to do it? Yeah, you can gamble if you want to speculate. You can do that.
Go for it, Cam.
Okay, so a couple of people are selling it. Right, I saw this as well. So people are selling it. People were gifted. Some people converted their options over. Okay, but one thing I look for is that people who are selling it, I don't see Mark Zuckerberg here. And he's the chairman and CEO.
Mm-hmm.
So for me, a huge red flag is if the CEO is continually selling his shares. Okay? And then I look at the rule one number.
What's gift? What's gifting?
Somebody gave somebody shares as a gift.
Correct. So there's some companies that if you get employed, they give you stock options.
Oh, gotcha.
Yeah, like if you work at Amazon, depending on what you do, they give you stock shares as part of your benefits package. So most CEOs and CFO and higher level executives get stock options as part of their benefit package. But everything is green here. Everything is green here.
Good.
Okay. They have zero debt.
That's a good thing.
And the margin of safety for Facebook, and I'm not telling you guys to invest in Facebook. I've done more extensive research into it than this. The margin of safety says this company is worth $247.
Oh, wow.
Your price is $494.
And you bought it for how much?
Right now, it's selling for $150.
How much did you buy it for?
I bought it for $130.
Okay.
So I'm already up, I think about 15%. So if I literally sold my stocks today in Facebook and didn't trade or invest the rest of the year, I would beat the market. And it's so crazy that I invested in Facebook like 3 weeks ago. So it's super easy to beat the market, guys. Once you understand the rules, once you know how to pick companies, like I just bought it and I just forgot about it because I wanted to hold it for 10. You said what, Jamal? Huh?
That's strong.
You said that's strong? I don't get what you're saying.
It's a strong investment.
Oh, it's a strong investment, correct. Okay. So one thing people always ask me is that if the stock market crashed today, right?
Mm-hmm.
And the stocks of Facebook dropped, would I panic? And my answer to them would be no. And the reason is because I'm valuing the company based on cash flow. Regardless of what the economy does, whether the economy crashes today or tomorrow, the cash flow of a company fairly remains stable or goes up. So I looked at the history of Facebook in 2008. Actually, during the recession, Facebook went up. Right? Because people were looking for ways to make more money and advertise, so they chose Facebook as that platform. So there's something known as stockpiling. Okay? And this is the question. If something goes on discount, do you buy more or less?
More.
More, exactly. So if Jordans went on sale for $50,
shoot,
I'm going to buy as many Jordans as possible because I know in 3 years I'm about to sell them bad boys for like $300 each. When the stock market goes into a crazy frenzy, even if the stock price of Facebook was to drop to $70, I'm going to buy more. That means it's going even more on discount, and it's called stockpiling. So once you found a company that you believe in, that you can invest in, you can literally make millions off that one company with different trades and transactions. Okay, guys? And lead them to a point where you take your money off the table. So I'm going to share more of that next week. Next week, you're going to go into the Rule 1 numbers, go more into understanding the company and what you have to do to really get a full picture and be confident in your investing. So don't forget to check back in the course, set up your Think and Swim paper account, okay? Watch the other video, Millionaire Math. And by the weekend, there will be more videos in there that you guys need to watch before our next course. And also make sure that you do your quick analysis. And I want one company that you've went through each of the quick analysis for these 4, and you're all going to talk about it next week. Okay, guys?
Okay.
Mm-hmm.
All right, any final questions?
No.
All right, great, guys. It's been great having you. That's the webinar slide. You don't need to see that. You already saw that. But yeah, feel free to reach out to me if you have any questions, or during the week you ran into a company, you need any help. You have my number. Just feel free to text me.
Okay.
Thank you.
All right.
Thank you.
No worries. I'm going to put this recording inside the group as well. So if you guys want to go back and rewatch it, you can go ahead and do that.